Hello, and welcome to another stock analysis on Stock Market Palantir. Don't forget to subscribe and drop your comments. Now, let's go hear our analysts.
Welcome to the Stock Market Palantir. Today we are going to talk about AAL.
Yes, American Airlines Group. We're looking at it here in mid-December 2025, and it's really at a fascinating inflection point.
It absolutely is. The price action recently has been pretty compelling. We've seen it confirm a decisive technical breakout. It's been trading, between 1486 and 1504, and it culminated in a really strong gain on Tuesday, December 9th, closing at $15.04.
And that close is the key, right? It's not just a three-day winning streak. It's that it broke and then held above that critical 1489 resistance level. That's a technical signal you just can't ignore.
Exactly. It suggests real momentum, and it's supported by a mix of things. Some recent fundamental wins like that solid Q3 report and, some clear operational victories.
And that's really the tension, isn't it? You have these bullish technicals, a new MACD buy signal, that 1489 level turning into support, but it all runs right up against these massive, persistent structural liabilities.
So that brings us to the central question. Does this current momentum in AAL represent a real, fundamental structural recovery that's supported by deep value and operational resilience, or is it mostly just a speculative, short-term momentum play that's masking some really significant long-term leverage risk?
And that's where we differ.
It is. I'm going to be arguing today that the operational wins we've seen and the deep underlying value in the 80 Advantage program really do justify this upward move and signal a genuine turnaround.
And I'm coming at it from another angle. I believe that while the surface action looks good, the combination of, specific market microstructure concerns, I'm talking about the massive volume in dark pools and just the crushing size of the debt burden, suggests this rally is actually highly fragile. I see AAL as a high-risk speculative asset right now.
Okay, well, let's start with the evidence for the recovery. I think American has shown some really idiosyncratic resilience this past quarter. It's managed to decouple itself from some of the wider industry problems we saw in Q4. The core fundamental justification has to be the Q3 2025 earnings beat. I mean, revenue was robust, hitting a record $13.7 billion, which, comfortably beat the $13.63 billion consensus. But the real surprise wasn't on the top line. It was the cost control, the adjusted loss of 17 cents per share. It just dramatically outperformed what analysts were expecting, which was a 28-cent loss.
That is a significant beat.
It is. And for them to do that when the whole sector was facing headwinds, it suggests they are really finding efficiencies. But the undeniable catalyst, the thing that really moved the stock, was the forward guidance. Management guided Q4 adjusted EPS to come in between 45 and 75 cents. That forecast just shattered the analyst consensus of a cautious 31 cents. To go from a Q3 loss to guiding a Q4 profit that high, it really implies they've pivoted past the trough of their earnings cycle.
I respect the bullish take on guidance, but guidance is exactly that. It's a forward-looking forecast that depends on zero operational friction and continued robust pricing. Before we celebrate a forecast, let's talk about a core financial fact. AL is carrying approximately $36.1 billion in total debt.
It's high, no question.
It's not just high. It is by far the heaviest debt load in the entire industry. It's significantly higher than Delta's $21 billion or United's $31.3 billion. And that massive debt means two things. First, interest expense is a huge drag. And second, to justify the current valuation, if you look at the forward PE ratio, it's around 17.84. AAL is trading at a substantial premium over the industry average of 10.65. So you're paying a hefty premium for earnings from a company that requires nothing less than absolutely flawless execution to manage that $36 billion debt.
Okay.
And I also have some serious structural concerns about the market microstructure that's fueling this price action. Our data shows that nearly 49% of AAL's daily trading volume is executed off exchange in dark pools. This shadow liquidity
It dampens the visible volatility, and it means institutional positioning is happening without full transparency. In my view, the valuation premium is less about a structural recovery and more a symptom of high leverage distorting the metrics, coupled with speculative flow that loves this kind of opaque trading.
I see why you'd focus on that as a warning sign, but let's dive into that 49% dark pool figure, because I actually interpret it in this specific context of a clean technical breakout as fundamentally bullish accumulation.
How so?
Well, you mentioned the transparency issue, and that's valid. But let's think about the mechanics. The high level of off-exchange volume confirms robust retail demand. These orders are often routed to wholesalers, like Citadel or Virtue. If they can't instantly find the inventory to satisfy that stream of buy orders, they're forced to short the stock to facilitate the trade immediately.
I'm just not convinced by that. The high short volume, which is nearly half of that off-exchange total, it tells a story of speculative churn. And the lack of transparency is the core problem here. While you can rationalize the shorting as inventory management, the fact remains that 49% of the volume is hidden.
But that's how the market works for these high-volume names.
Look, it means the stock attracts highly speculative, high beta flow. You don't see this level of dark pool activity in a stable airline like Delta. You see it in names like American or United, which are structurally higher risk and attract traders looking for quick momentum. If institutional investors were truly accumulating for the long term, why would they risk buying at a 17.84 PE when the core business is leveraged to the hilt? They'd be buying quietly at lower levels.
That high PE is a legitimate point on the debt structure, but let me push back on this idea that it's purely retail speculation. That 49% figure also confirms significant institutional block trading is happening. Institutions use dark pools precisely to avoid signaling their intent on the open market and causing slippage. When they're accumulating massive blocks of shares, say around that $14 to $15 level, they do it off exchange so they don't move the market against themselves. This looks more like institutional accumulation seeking an efficient entry. It confirms they believe in the narrative we're about to discuss, the A-advantage deep value thesis.
Okay, that's a compelling point about institutional buying, but let's connect this back to the fragility of the whole investment thesis. The prevailing narrative, especially for retail, is all about the A-advantage loyalty program being this deep value play.
Right.
And the logic is seductive. I get it. The airline's market cap is about $9.8 billion, and the loyalty program, especially with that enhanced 2026 Citi deal, is projected to deliver nearly $10 billion in annual revenue. So the narrative is you're buying a high-margin financial business, A-advantage, and you're essentially getting the entire airline operation for free.
It's a powerful argument.
It is, but this narrative relies on complexity and, frankly, a lot of confusion that drives that retail flow. The investor base is fragile. I mean, there is still persistent confusion out there about a reverse split. I hear it all the time. It's a myth, but it comes from that messy history. The 2011 AMR bankruptcy and the 2013 merger, where the old shareholders were basically wiped out. That feeling of a reverse split, that risk, it lingers. And a stock that relies on interest partly driven by historical misunderstandings is inherently unstable if the airline side of the business stumbles.
Okay, I'll concede that the history of the equity reset often confuses less informed investors on the reverse split myth, but the A-advantage valuation thesis is not reliant on retail confusion. It's sound structural finance. This valuation floor is what institutional capital is seeing in those dark pool blocks. The loyalty program is a high-margin, recurring revenue stream. You can value it at a much higher multiple than the core airline business. So when the entire company's market cap is less than the projected standalone value of that single asset, well, institutional capital sees a clear discount. It's a classic sum of the parts argument independent of what the average day trader thinks.
Fair enough on the institutional view.
So let's shift to the sustainability of this recovery versus those external headwinds. I would argue that the company's operational resilience has created a sustainable path that actually minimizes those external risks. I mean, just look at the operational victory in late November. They rapidly resolved that software error, which was induced by solar radiation of all things, that grounded 209 of their Airbus A320s. They fixed it and got the fleet back in the air within 48 hours. That kind of crisis management prevents massive revenue leakage, and it validates that this team can handle complex logistics.
Operationally, yes, that's admirable. It's necessary. But it doesn't solve the structural financial burden, and it doesn't address the regulatory risk, which is a massive external headwind that I think the market is entirely ignoring right now. I'm talking about the lingering risk from that 43-day government shutdown back in October and November, the FAA investigation into their compliance with the mandated flight reductions. It's still ongoing. The theoretical risk of $75,000 per violation is a catastrophic wild card. The market is just discounting this entirely, assuming the FAA will be lenient. If they decide to enforce fines rigorously, that could shatter this whole breakout narrative.
See, I disagree that the market is ignoring it. I think it's rationally pricing in leniency precisely because of those operational wins and the clear financial path forward. Let's counter that external risk by looking at their internal controls over future capital needs. The deleveraging path is clear and achievable. American currently has the youngest fleet among the U.S. majors. This is a critical point because it means their future capex, the money they need to buy new planes, is going to be significantly lower than their peers. This means the projected positive free cash flow, which management guided to be over $1 billion for 2025, can be overwhelmingly directed toward paying down debt. That accelerates their deleveraging speed faster than competitors, and that's the metric long-term valuation ultimately depends on. Plus, you can't ignore the macro environment. The IATA 2026 forecast is projecting a record year for the global industry. A rising tide lifts all boats, and AAL is positioned to capture that demand with its efficient fleet.
The IATA forecast is a tailwind, yes, but it is not an idiosyncratic defense against fixed interest costs on $36.1 billion. Any slight miss on capacity, any softening of pricing, any spike in fuel costs will disproportionately hurt AAL precisely because of that mammoth debt. The stock is currently pricing in a perfect macro environment, zero FAA fines, and flawless execution. That's just a very tight margin for error. And the fact that 49% of the trading is happening in shadow liquidity suggests to me that traders, not long-term investors, are the ones betting on that perfect path. That warrants caution.
I see the tight margin, but the evidence from Q3 and the Q4 guidance suggests they're actually meeting that high bar for execution right now.
For now.
So to summarize my position, I think AAL currently merits a speculative hold, leaning towards accumulation. The stock's breakout isn't just technical momentum, it's underpinned by demonstrable operational superiority and a strong valuation floor from the loyalty program. And while the debt is undeniably high, the path to deleveraging is clear, it's accelerated by low future capex and strong free cash flow guidance. The institutional accumulation we see just confirms a belief in this structural recovery.
And conversely, I conclude that the stock remains firmly in the high-risk, high-reward category, and that the risks are currently underpriced. The momentum and heavy speculative flow, confirmed by that huge off-exchange volume, are just not enough to overcome the sheer magnitude of the debt without a sustained period of perfection. The stock is relying on a best-case scenario for the FAA risk and needs the industry to hit all its growth targets. The complexity here just requires extreme vigilance, and buying in at these premium PE levels feels unnecessarily fragile to me.
It's clear the interplay between AAL's operational stability and its deep structural financial complexity creates a truly compelling, if highly volatile investment profile.
Yeah, it really requires investors to constantly weigh that immediate evidence of positive cash flow against the massive future obligation of that $36 billion debt. There's definitely more to dig into here.
Thank you very much for hearing us. Let us know in the comments what's your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.